I spent $10,000 on silver during the crash. Was it a genius move? Have you ever held a piece of history in your hand and felt the weight, not just of the metal, but of the decades and the economic stories it represents? What if I told you that a simple decision to buy a tangible asset during a moment of market fear could be one of the most profound statements you ever make about your financial future? We are not just talking about an investment. We are talking about a strategic maneuver in the silent, ongoing war against wealth erosion. A war that most people don't even realize they are losing day by day, dollar by dollar. The prevailing economic condition of our time is a paradox of perceived wealth and silent decay. We live in an era of digital transactions, soaring equity markets, and unprecedented currency creation. Yet the purchasing power of the average person's savings is continually being hollowed out by inflation. The problem is not a lack of money, but a fundamental misunderstanding of what money truly is. Fiat currency, the government-issued money not backed by a physical commodity, is a tool of policy, but it is also an instrument of slow, insidious confiscation through debasement. Most investors react to this reality with fear, especially during market corrections. They see a price drop as a loss, a signal to sell, when in fact it should be viewed as a rare moment of clarity, an opportunity to exchange depreciating paper for an appreciating tangible asset at a discount. The recent pullback in the silver market presented just such an opportunity. This wasn't a signal of failure for the asset. It was a necessary and healthy market correction, shaking out speculative excess and allowing for consolidation before the next potential leg up. The true catalyst for action, however, is not the dip itself, but the informed decision to capitalize on it with a well-defined strategy. This is where a mere purchase transforms into a sophisticated investment thesis. The acquisition of over $10,000 worth of physical silver, diversified across various forms, represents a powerful disruption to the conventional wisdom of fleeing to cash in times of uncertainty. It is a calculated move based on the understanding that in a world of infinite digital currency, finite tangible assets hold the ultimate power. The investment strategy deployed here is a masterclass in diversification within a single asset class, a concept many investors overlook. The foundation of this purchase was 100 ounces of generic silver rounds. These are the workhorses of any precious metals stack. Their value lies in their proximity to the spot price of silver, offering the most metal for the currency expended. Items like the classic Buffalo rounds or the striking E pluribus unum silver liberties are not meant to be rare collector's items. They are a direct, low-premium play on the intrinsic value of silver as an industrial and monetary metal. This portion of the portfolio is the liquid, foundational layer, designed to capture the broad upward movement of the commodity price itself without the complexities of numismatic premiums. Moving up the ladder of specialization, we see the acquisition of 45 ounces of 2014 half-ounce Mexican Libertad coins. While still bullion, the Libertad series carries a semi-numismatic premium. These coins are renowned for their beautiful design and are produced by the Casa de Moneda de Mexico, the oldest mint in the Americas. Their limited mintage compared to coins like the American Silver Eagle gives them an added layer of desirability among collectors. Securing these for a mere dollar over the spot price is an incredibly astute move. It represents the capture of not just silver content, but also potential premium appreciation, providing a potential performance kicker that generic rounds might not offer. This is the strategic middle ground between pure bullion and high-end collectibles. The next layer of this sophisticated stack delves into the world of numismatics, where history, rarity, and condition become the primary value drivers. The purchase included a range of certified, or slabbed, coins, primarily Morgan silver dollars from the late 19th century graded at a mint state 63, MS63 level. An MS63 Morgan is a beautiful, uncirculated coin that represents a piece of American history, a time when money was physically weighty and artistically crafted. Paying $75 for such a coin, when its silver melt value is only a fraction of that, is a bet on the enduring appeal of numismatic collecting. In a financial crisis or a flight to tangible assets, The premium on these historical artifacts could expand dramatically as new buyers enter the market seeking not just silver, but tangible history. The portfolio was further enhanced with the inclusion of proof American silver eagles. Unlike their bullion counterparts, proof eagles are struck multiple times using specially polished dies, resulting in a stunning mirror-like finish. They are produced in much smaller quantities and are packaged for collectors from the U.S. Acquiring these for $65 apiece, only a moderate premium over bullion eagles at the time, demonstrates a keen eye for value. As the premiums on standard bullion silver eagles have been rising due to mint supply issues and heightened demand, the relative value proposition of these proof coins becomes even more compelling. This is a strategic acquisition of a premium product at a price that could soon seem like a bargain, providing another vector for potential outperformance. Perhaps the most intellectually compelling component of this $10,000 investment, and the one that provides the most profound lesson in economics, is the acquisition of vintage dime saver and quarter saver folders from the 1940s and 1950s. These are not just collections of old silver coins, they are time capsules of a bygone monetary era. These cardboard folders, issued by banks like the Firestone Bank or the Akron Savings and Loan Company, encouraged daily savings. The quarter saver, for instance, held 20 quarters. When full, it contained $5. Today, the silver melt value of those 20 quarters is approximately $175. This simple artifact is one of the most powerful visual aids for understanding the catastrophic decline of the U.S. Dollar's purchasing power. This collection of vintage bank savers serves as the philosophical core of the entire investment. It's a tangible, irrefutable counter-narrative to the official story of low and controlled inflation. What was once $5, a significant sum, now has a metallic value 35 times its original face value. Yet the crucial insight is that the $175 of today arguably buys less in real terms of goods and services than the $5 did in the 1950s. This isn't just about silver going up, it's about the dollar going down. Keeping these folders intact, perhaps even shrink-wrapping them to preserve their historical integrity, transforms them from a simple stack of silver coins into a museum-quality exhibit on currency debasement that also happens to be a highly effective store of value. The critical event, the tipping point, has not yet occurred, but every deliberate action like this $10,000 silver purchase is a vote of no confidence in the current trajectory of monetary policy. The tipping point will arrive when the collective realization of currency debasement moves from the fringes of the financial world to the mainstream consciousness. This could be triggered by a sovereign debt crisis, uncontrolled inflation that can no longer be explained away by transitory factors, a geopolitical shift away from the U.S. dollar as the world's reserve currency, or a major disruption in the physical silver supply chain. When confidence in paper assets and digital promises evaporates, there will be a frantic, panicked rush into tangible assets that cannot be printed into existence. This is not a far-fetched doomsday scenario, it is the historical norm. Every fiat currency in history has eventually returned to its intrinsic value, zero. The current global experiment with unbacked paper money is unique only in its scale. The investor who strategically acquires real assets during periods of calm or minor correction is not a speculator. They are a realist. They are positioning themselves on the right side of a great wealth transfer that will occur when the market's perception of value is forced to reconcile with reality. The $10,000 investment is a single, personal lifeboat, but it is built on a principle that could preserve the wealth of millions. The tipping point is the moment when everyone else starts looking for a lifeboat, only to find the prices have gone vertical. In the aftermath of such a tipping point, the financial landscape would be fundamentally altered, and the performance of this specific, layered silver portfolio would be illuminating. The 100 ounces of generic silver rounds would serve their purpose perfectly, providing a direct, liquid hedge whose value would have multiplied in fiat currency terms. They would be the transactional component of the stack, easily sold or bartered if necessary, with their value universally recognized based on weight and purity. This foundational layer would have protected the initial $10,000 of purchasing power and likely increased it substantially, fulfilling the primary objective of any sound money advocate. The semi-numismatic assets, such as the Mexican Libertad coins, would likely experience a dual benefit. Their value would increase in line with the rising spot price of silver, but their premiums would also be expected to expand significantly. As a wave of new, less experienced buyers floods the market, they often gravitate towards government-minted coins with recognizable and beautiful designs. The limited mintage of the Libertads would create a supply squeeze, driving their collectible value far higher than that of more common bullion. The initial small premium paid for these coins would be magnified, leading to dramatic outperformance relative to simple generic rounds. This demonstrates the power of adding a layer of collectability to a bullion foundation. The true outperformance, however, would likely be seen in the high-grade numismatic and historical assets. The MS-63 Morgan dollars and the proof silver eagles would be sought after not just by traditional collectors, but by a new class of panic buyers, seeking the perceived safety and prestige of certified, historical, and limited edition coins. The $75 Morgan dollar could easily become a multi-hundred-dollar asset, its price driven by a flight to quality and rarity that transcends the underlying metal value. The market for these items would become highly illiquid on the sell side, as existing holders would be unwilling to part with such treasures for depreciating fiat currency, further exacerbating the price explosion. And what of the vintage dime and quarter savers? These items would become the ultimate trophies of the new financial era. Their value would be almost impossible to quantify in traditional terms. They are not merely collections of silver coins, they are profound symbols of the very crisis that has unfolded. Their story, the story of saving a dime a day to accumulate real wealth, would resonate powerfully in a world reeling from the failure of paper money. Collectors, investors, and even museums would seek out these artifacts. The decision to keep these folders intact would prove to be a stroke of genius, as their value as a complete historical piece would far exceed the sum of their silver parts, making them a centerpiece of a truly prescient investment strategy. The ultimate takeaway from this meticulous $10,000 investment is a lesson in financial sovereignty. It is about rejecting the passive acceptance of currency debasement and actively building a fortress of tangible wealth. The strategy demonstrates a multi-layered approach that is both defensive and opportunistic. The generic bullion provides the foundation, the semi-numismatics offer premium appreciation potential, the certified coins add a layer of historical rarity, and the vintage bank savers provide a powerful philosophical and economic anchor. This is not simply stacking silver. This is a carefully curated portfolio of real money designed to thrive in an environment of monetary chaos. The enduring principle we can learn is that the time to prepare for a storm is not when the rain has already begun to fall, but when the skies are merely graying. Market pullbacks are not threats, they are invitations to exchange weak assets for strong ones at a favorable price. By understanding the different forms of silver and their unique characteristics, an investor can construct a portfolio that is robust, diversified, and poised for significant upside. This $10,000 unboxing is more than just a reveal of shiny objects. It is a blueprint for wealth preservation in the 21st century, a lesson that will only become more valuable as the flaws in our current financial system become more apparent to all. Let us delve deeper into the psychology of the market that makes such an opportunity possible. The average market participant is driven by two powerful emotions, greed and fear. During a bull run, greed dominates, leading to speculative frenzies and the bidding up of assets beyond their intrinsic value. During a correction or pullback, fear takes over. The herd mentality shifts from buying at any price to selling at any cost. The rational investor, the one with a long-term perspective grounded in economic history, understands this cycle. They know that a price correction for a fundamentally sound asset class like precious metals is a gift from the fearful to the patient. Driving 5 hours to a coin shop is not an act of obsession. It is an act of arbitrage against market sentiment. The relationship between the dealer and the informed investor is also a critical, often overlooked, aspect of this strategy. The source mentioned that the dealer had recently purchased over $1 million in gold and silver from the public. This happens because as the spot price rises, many individuals who bought at lower prices are tempted to sell and take profits in fiat currency, failing to grasp that they are trading a superior form of money for an inferior. This influx of supply into the secondary market creates the very inventory that allows an astute buyer to acquire assets, often at a lower premium than they would find from a major online retailer. It is a symbiotic relationship where the dealer profits from the spread, and the strategic buyer profits from the market's short-sightedness. Consider the nuance of the deal struck for the 100 ounces of generic silver rounds. They were acquired at spot price, a deal made possible by a convergence of factors. The dealer had just bought them for under spot, the buyer was physically present and making a substantial purchase, and a long-standing relationship likely played a role. This highlights a crucial lesson for any serious investor in tangible assets. Relationships matter. Building a network with reputable local dealers can provide access to opportunities and pricing that are simply not available to the anonymous online shopper. It transforms the investment process from a simple transaction into a strategic partnership. The inclusion of the 1893 Colombian commemorative half-dollars is another stroke of genius. As the first commemorative coin issued by the United States, it holds a special place in numismatic history. While it is 90% silver, its value is tied more to its historical significance than its melt value. Paying $21 for a coin with less than $10 of silver in it may seem foolish to a pure bullion stacker, but it is a wise move for the diversified investor. These coins have a dedicated collector base, and their value tends to be less volatile and less correlated with the daily fluctuations of the silver spot price, adding a stabilizing element to the overall portfolio. Furthermore, the wartime series of Walking Liberty half-dollars from 1941 to 1945 tells a powerful story. These coins circulated during a period of immense national sacrifice and global turmoil. Owning a brilliant uncirculated set from this era is to own a piece of that history. The premium paid, $175 for the set, is an investment in that story and the aesthetic beauty of what is often considered America's most beautiful silver coin design. In a world increasingly detached from its past, tangible artifacts that connect us to pivotal historical moments carry a unique and growing cultural premium, which often translates into a financial one. Let us analyze the graded coin purchases more granularly. The portfolio includes not just uncirculated Franklin half-dollars, MS-64, but also proof versions PF66, PF67. This shows a sophisticated understanding of the coin grading landscape. A proof coin is a distinct category from a business strike coin, intended from the outset as a collector's item. While the Ben Franklin series is not as popular as the Morgan dollar, high-grade proof examples, especially without distracting cameo designations, can be undervalued. Acquiring these for between $25 and $30 is a low-risk bet on a future resurgence in collector interest for mid-century modern American coinage. It is a niche play within a niche market, demonstrating a truly deep level of strategic thought. The purchase of a 2013 American Silver Eagle-graded MS-69, notable for its mint-sealed box, label, and green rim, is an interesting play on modern numismatics. While an MS-69 is a very high grade, millions of Silver Eagles exist. The value here is in the unique presentation, the label signifying it came from an original sealed green monster box from the US. Mint. This appeals to a specific subset of modern coin collectors who value provenance and unique labeling from grading services. Paying a $7 premium over spot for such a coin is an excellent value, as similar certified eagles on the retail market often command much higher premiums. It's a small but savvy acquisition that could be easily liquidated for a quick profit or held for its novelty appeal. The future for silver is underpinned by a powerful dual demand that few other assets possess. On one hand, it is a monetary metal, a store of value with a 5,000-year history of being used as money. This is the demand that awakens during times of financial crisis and currency debasement. On the other hand, silver is an indispensable industrial metal. It is the most conductive and reflective metal on the planet, making it essential for solar panels, electric vehicles, 5G technology, and countless medical and electronic applications. This industrial demand is not speculative. It is real, growing, and largely inelastic. As the world pushes forward with green energy and technological advancement, the demand for physical silver is set to increase structurally. This creates a potential future tipping point of a different kind, a physical supply squeeze. For decades, silver supply from mining has been supplemented by the selling of above-ground stocks, such as old silverware, coins, and investor selling. However, as industrial consumption continues to ramp up and investor demand for a safe haven asset grows, we are rapidly approaching a scenario where annual demand outstrips annual mining and recycling supply. When this deficit becomes chronic and widely understood, the price discovery mechanism could break. The price would no longer be set by futures contracts on a paper market, but by the desperate bidding for the physical metal itself. In such a scenario, the premiums on all forms of physical silver would explode. The distinction between a generic round and a government-minted coin would become less about the small percentage difference in premium and more about availability. Anyone holding the physical metal would be in a position of immense power. The $10,000 investment, which now seems substantial, would appear as a pittance in hindsight. The value would not be measured in how many depreciating dollars it is worth, but in what it could command in real goods and services. It would represent not just preserved wealth, but generational wealth created from a single, contrarian decision. The impact on the broader economy would be profound. A true silver squeeze would signal a massive loss of faith in the established financial order. It would be a grassroots monetary revolution, a collective decision by individuals to opt out of a failing system and return to a system based on tangible value. Governments and central banks would likely react with desperate measures, price controls, confiscation, or the creation of new digital currencies designed to eliminate the anonymity and sovereignty that physical metals provide. This makes the act of taking personal possession of one's assets now, before such measures are contemplated, an act of profound foresight. The ultimate aftermath is a return to a more honest financial system. Whether silver is formally remonetized or simply serves as a benchmark of real value against which other assets are measured, its role will be re-established. Those who held it through the turmoil will have successfully navigated the greatest wealth transfer of our lifetime. The investor who bought the dime savers would be able to look at them not just as a quaint historical artifact, but as the very instrument that preserved their family's purchasing power through the great monetary reset. The story becomes the asset, and the asset becomes the foundation of a new financial legacy. Therefore, the final lesson is one of action. It is not enough to understand the theories of monetary debasement or to watch videos about market dynamics. Knowledge without action is meaningless. The $10,000 purchase was the physical manifestation of a belief system, a conversion of intellectual understanding into tangible reality. It is a call to every individual to examine their own balance sheet, to question the long-term viability of their paper and digital holdings, and to consider dedicating a portion of their wealth to assets that have stood the test of time. This is not about fear-mongering. It is about prudent, long-term planning based on the clear and repeating lessons of monetary history.